Hey traders, Mike from CapitalHillFX. In this video, we're going to be going in depth of how you could effectively manage and control risk in the foreign exchange market. Now, I know what you may be asking yourself, Mike, why would I want to control risk in the world's largest financial market? Well, there's a couple different reasons for that. First is the unpredictable nature of the foreign exchange market. There are going to be times where you're placing trades and price doesn't go in the initial direction that you thought it would. And in these moments, if you plan to fail, you fail to plan. And as cliche as that line sounds, it's so true, especially for new and aspiring traders. Most of the time when new traders go into drawdown on a trade, they usually trade on their heels and they're trading off of emotions and hopes. And that's something that we want to completely eliminate when we're trading Forex. So we want to have a logical risk management practice so that we're practically and sustainably trading the markets for a sustainable period of time rather than just trading off of emotions and over leveraging our account. So let's actually go over some different practices that we could implement to properly manage risk in the foreign exchange market. Let's say that we're just trading bounces off of daily horizontal levels, just like I do. And price is coming up to a significant horizontal level, and we have some type of bearish price action forming around the significant horizontal level. So what we decide to do is place a sell off of this horizontal level because we expect that price is going to head towards the downside. So what we do is we just place a sell, maybe the take profit targeting a previous structural low, and then the stop loss right above the zone. So this basically means if price continues towards the upside and we just wipe through the zone, price will take us out at a predetermined price point and we will have that predetermined loss right away. So we won't even stay in this trade any longer than we have to be just because it will take us right out of the markets at this certain price point. So that is basically what a stop loss is taking you out at a predetermined price point so that we don't incur any more losses on the trade. So let's say that we had price go towards the upside and we end up getting stopped out of this trade. So that means whatever our predetermined risk for this trade was, let's say it's 2%. If we risk 2% on this trade and it hit our stop loss, we would lose 2% of our account balance on this exact trade. So there's going to be times where you obviously hit stop loss. There's going to be times where you hit take profit. There's going to be times where you hit break even, right? So with your typical stop loss, this is exactly how the risk management practice would go. You just place your stop loss above an invalidation zone, and our invalidation zone would usually be right above the zone. Maybe if we wicked at this level previously, let's say we've rejected off this level previously, maybe our invalidation zone would be above these previous highs. So we could see that price has rejected away from this zone in the past. So we would probably put our stop loss somewhere above these previous highs, because if price wipes out these previous highs, then we don't want to be in the trade any longer, because after all, we are trading off of this significant horizontal level. So that is one risk management practice that you could implement into your trading system to practically trade the foreign exchange market, is just placing stop losses above or below certain invalidation zones, just so that you're actually getting taken out of the markets when price isn't going in the initial direction that you thought it would. So stop loss is the first way. And the second way is a little bit different. It's known as hedging. So let's say that we had this same exact trade idea where price was coming up to a significant horizontal level and we found some type of bearish rejection around this significant horizontal level. And let's say we placed a sell around this significant horizontal level. And this red arrow is going to signify that we're placing a sell off of this significant horizontal level. But instead of a stop loss, we're going to place what's called a hedge order. And a hedge order is basically just, if price triggers this order, that we're going to place an opposite position to manage risk effectively. So let's say we have a sell order around the significant horizontal level, and let's say we have our take profit somewhere down here, right, at this previous structural low that we've already put in. So this is basically saying that price is coming up to this significant horizontal level. We already got entered into this trade for a sell. And let's say price doesn't respect this zone. It just continues towards the upside. So instead of in the previous risk management practice where we would just get stopped out of the trade and we get exit out of the trade at a predetermined loss, we would actually get entered into a buy order. So an opposite position of the position that we're already in. So we were in a sell, and now if price went up to this significant price point, wherever our hedge order is, we would get entered into a buy order. And of course, these would be the same position. So let's say we entered this, just to make this very simple, we entered the sell at 0.10. the hedge order would also be at 0.10, and this is a lot size. So it would be the same position for each one of these orders. And basically what this is doing is this is locking you into a loss, but actually isn't taking you out of the trade, right? So you're not actually taking out of the trade. You're just, for the time being, pausing your own positions on your MetaTrader 4 or whichever platform that you're using. You're pausing the loss so that when price does come to another significant horizontal level, you could make another trading decision around that significant horizontal level. And we will go into backtesting data and test and see effectively how we could use this risk management practice, because not many people actually hedge on a day-to-day basis, especially new traders. They mostly use stop losses or they just over leverage their account in general. So we want to effectively know what hedging is so that we could implement it into our trading system. So instead of, like I said, instead of being taken out of the trade, we would get launched into another buy order. So we had a sell order here. If we came up and popped above this zone, we would get entered into a buy order. So now we are in a sell and a buy. And again, none of these have stop losses because this is not that type of risk management practice. We are not placing stop losses on any of these types of orders, especially if we're hedging. So why would it be beneficial to use hedging in the foreign exchange market? Well, rarely do you ever lose if you're using hedging in the foreign exchange market. And I'm not going to say that you win 100% of the time, but it decreases your losses drastically because you're just reacting to whatever the market is doing instead of trying to predict what the market is doing. So in this scenario, like we said, if price, we are predicting that price is going to head towards the downside. If we have a stop loss right here, that basically means if price comes up here, we're out of the trade, we lost. But with hedging, if price pops above this zone, it doesn't mean that we lost technically. It just means that now we're entered into this buy order and we could take the position all the way up to another significant horizontal level and then take profit with this buy order and then place a sell order off of this zone and then bring it all the way back to this zone. And then we could enter this initial sell at break even and this order at profit. So not only did we have a profitable trade with this buy hedge, but we would have also had a profitable trade with the sell order towards the downside. So we will see this logically in backtesting data, which we could do right now. And if you don't know how to effectively backtest your trading system, I already did a video outlining step-by-step how to effectively backtest your trading system. So you definitely want to take a look at that. So right now we're just going to backtest and sort of see how we could properly hedge the foreign exchange market. So I'm going to replay back to a certain date right now. And again, we're only going to place 1 or 2 trades just to effectively see this. So for those of you who don't know my trading strategy, it just bounces off of daily horizontal levels. So I'm just going to outline some significant horizontal levels. Again, all of these levels are very subjective to me, so I don't want you to think that these are the do-all, be-all, say-all type zones. Like, these are very subjective. So whatever zones appeal to you, make sure to outline those zones. So yeah, we do have a significant horizontal level right here. And right here seems pretty nice. So we're going to sneak down to the hourly time frame, and this would have already been an entry right here, but I'm going to act like we weren't here. And I do have these identifiers just showing the bearish or bullish price action around these horizontal levels. And we're just going to let price play out. So we could see price swipe through. So I'm going to come back and see if price could come back and test this as potential support, because we've had support in the past. And again, we do have this level here. So I'm going to see if price could come back and test as potential support. And I'm going to make this back testing as quick as possible just so that we're depicting how to effectively hedge in these markets. So we can see price is coming up to the significant horizontal level. I'm just waiting for some type of bearish price action, whether it's a candle or whatever it may be. Not rejecting yet. Okay, so we had a tweezer top form around this significant horizontal level. If we go on the daily time frame, we could see that we're pushing heavily into this level, and then we go down to the hourly time frame, and we could see that we did form a tweezer top. So what I would do is I would place a sell order right at this tweezer top. And what would the invalidation zone look like? So if we go down to the 4-hour time frame, the invalidation zone, in my subjective opinion, would probably be somewhere above these previous highs, because price could still come up to here and reject. I would want it probably somewhere right here. So if we go down to the hourly time frame, our risk management would be hedging at this position, but I want to see sort of what the pips would be in from the entry to the hedged position. So we could see it's about 30 to 32 pips from the entry to the hedged position. So in your position size calculator, you're going to put 30 pips or 35 pips for the stop loss. It's not actually a stop loss, but it's basically how far away from your entry position and your hedged position is. Then you could effectively get a lot size that would correlate to this type of trade. So our stop loss, quote unquote stop loss for a position size calculator would be 30 to 35 pips. Just remember that this isn't actually a stop loss, because if price does head towards the upside and completely skies towards the upside, it's just like the same amount of loss if you got stopped out of that trade. Because remember, if it does go towards the upside, we're not occurring more loss because we have this buy order. And then if it goes towards the downside, we're not occurring more loss because we have the sell order. So that's why it evens out to a fixed amount of loss, even if we do have an hedge order. So we're just going to see how this plays out, and I'll take profits probably around this level right here. But if it ends up going towards the upside, then we'll manage the trade accordingly. So let's see what price ends up doing. Ends up pushing towards the downside. If we go to the 4-hour time frame, again, I would want to put in I would want to take profits around a significant horizontal level. This one just seems the most significant to me, so I'm just going to see if we end up coming down to this significant horizontal level. This was a very aggressive push towards the downside, so we'll end up seeing if we push into the zone. Okay, so right there would have been a clear take profit. So we wouldn't have even had to use the hedge order, but I want to get into a trade where we have to use this hedge. Let's see if we could find some bullish rejection around this significant horizontal level. Because remember, if we go to the 12-hour time frame, this was respected as support in the past. So we could potentially bounce here as support in the future. So we're going to go to the hourly time frame and see if we get some type of bullish price action forming. If we break through the zone, who cares? Okay, so perfect. So after this bullish engulfing, we would have entered a buy order. So let's say we entered a buy order right here. And then remember, we have to take into consideration our invalidation zone and where we would be placing this sell hedge. So we could see that we have wicked here in the past. So right below this previous wick would probably be where I'm placing my sell hedge. So right there. If we go down to the hourly time frame, we'll see that this is probably near 30 to 40 pip stop loss or position, just like the one previously. Yeah, it's about 32 pips, almost identical to the one I placed previously. So we would put that into our position size calculator to get a correct lot size for the trade. So basically, we're just doing the same thing as previous. We're expecting a buy off of this significant horizontal level, and we'll probably take profits up to this previous level here. But even if we don't end up popping here for a buy and we end up dropping towards the sell, then we could take this price all the way towards this previous zone. And then once price does get to this zone, we would take profit with this sell, and then we would place a buy off of this zone. And then if price bounces up here, then we would be able to close this at break even and close this one out at profit. So let's see, it's more of reacting to the market rather than trying to predict what the hell is going to happen. So let's see if we end up bouncing here. So perfect. So this is a great example. So we could see that we did have an initial bounce, but then price ended up coming down and would have hit our stop loss if we had a stop loss here, but ended up hitting our hedge. So now we are currently in a buy and a sell position. And remember, these positions are going to be the same lot size. So now we could sort of get a better idea of what price is going to do, and we could act accordingly. So now if we anticipated that price is going to actually head towards the downside, we could right about now exit this buy position and then enter another sell. So that's actually what I'm going to do right now, just because it looks like that price is potentially testing it as resistance. We've tested this zone as resistance multiple times. We've just briefly had a strong bear candle close below the level and then come back to test. So what I'm going to be doing is I'm going to exit this buy at break even, and then I'm going to be placing another sell order. So I'm just going to drag this over, place another sell order. And now we have two net sell orders. So we have one buy order that just exited break even. And then we have one sell order that we just recently placed. And then we had another sell order that we already had placed. And then of course, because we have these two sell positions, price could still head towards the upside. So we're going to need to place a hedge position if price does end up popping towards the upside. So We're going to place a hedge position around 30, 35 pips. Perfect. And remember, this is going to be have to be worth 2 positions because we do have 2 sell positions. So we're hoping that price does end up popping towards the downside. If not, no big deal because we still have a buy hedge. Perfect. So the buy hedge ended up getting activated. So we did get activated for these buy hedges, but it looks like the sell may end up playing out. So we're going to see where price ends up dipping down to. And again, I like this zone. So we'll see if price could end up pushing towards the downside. And that's the nice thing about the hedge. That's the nice thing about hedging is you literally don't get emotionally attached to whatever happens. It's like whatever happens, happens. You're going to just react to the market whichever way it goes. So we could see that we did push into this, was it sort of a 4-hour zone, but then we ended up coming back towards the upside. That's going to happen a lot. It's completely okay. You're just reacting to whatever's happening to the market. So we're going to see if price could push into one of these major zones so that we could sort of make a trading decision based on whatever happens. So we are coming back up to this significant horizontal level. So we're going to wait to see if price could push up to this zone and create some type of bearish price action. Let's see. Okay, so now we're starting to form some type of bearish price action around this significant horizontal level. What we would do is we would exit both of these buys in profit, of course. And we will count up all the pips after, but right now we're going to enter another sell right after this bearish wick. So let's recap what we have. So we just profited off of both of these buy hedges, and now we're going to enter another sell. So we're net 3 sell orders, 1 sell here, 1 sell here, and 1 sell here. These 2 sells are in major loss, but we profited off of both of these buys. So we're going to try to profit off of the bounce off of this significant horizontal level. And even if we don't, it's okay. We're going to have other hedges hedged right above this. So it would have to be 3 orders because now we're net 3 sell orders. And you don't have to place separate orders. You could just place more significant position lot sizes, if that makes sense. You could just place higher lot sizes instead of placing individual positions. But we're going to see if this ends up bouncing towards the downside. If it's able to bounce, then we could probably close this sell in a profit and close these at a minor drawdown, and it could probably end up profiting from the whole situation. Let's see if we end up bouncing. Testing the zone. So there we go. So we have to be very careful with where we want to actually exit this position just because we do have these sell positions very close to this zone, but we don't want to hold on to the position too long where price comes back up and then we're entered in these hedges. So I just want to get a good idea. We are about 125 pips in profit there. We are about 57 pips of drawdown there and about 89 pips of drawdown there. So what I'm going to do is I'm just going to close this out now, close all the positions out. So I would close this sell at profit. I would close this sell at a loss, and I would close this sell at a loss. Now we're going to add up all the orders and see if we ended up making money off of it. So we could see that we did take profit from this initial trade. This was 180, we'll call it, pips of profit. But that was just a simple bounce off of the horizontal level. No hedges got triggered or anything like that. And then, and of course, this could get very confusing because there are so many lines and stuff like that. Then we were trying to capture a bounce off of this significant horizontal level, but that didn't end up playing out. So we ended up getting a break even off of this initial buy order, if you remember, where price ended up bouncing through the level, coming back and testing as potential resistance, and we wanted to just get out of this trade. And then we had these 2 hedge orders that ended up profiting. Let's see how much we would have made off of these orders. We'll call it about 150 for each one of them. And again, we're measuring these in pips. So we would have had 2 orders that would have got plus 150 pips. And then we would have triggered this sell. So this sell would have gotten us 100, well, let's just call it 120 pips of profit. So this would have been 120 pips of profit. Perfect. And now we have these losses. So let's see what these losses would have been. So we had 56. Let's call it 60, just to be conservative with spreads and everything like that. Let's call it negative 60. And the other one was a little bit larger. I think it was probably 120, maybe double it. Nope, 90. So 90. So let's do the math here. So we had two positions cash out for 150 pips. That's 300 pips. And then we had another position. We're not even going to count this 181 because it didn't actually trigger a hedge. So let's just say that this was a profitable trade. Let's just worry about the trade that did trigger the hedge order. We have break even, so that wouldn't have had a loss or a profit. We had 150 and 150 from both of these buy hedges. And then we had another plus 120 from this sell order. So 150, 150, that's 300. Then plus 120, that's 420. And then we had minus 60, which again, I'm just trying to do all mental math here. So we had 420 minus 60. That is 360, I believe. 360. I'm not the greatest at math, but I believe that's 360. And then 360 minus 90, which I believe is 270. So 270 would be the net profit off of this whole entire situation. Now, if you had a typical stop loss, we would have gotten stopped out right from the beginning. We wouldn't have gotten any more trade opportunities if we were just using a typical stop loss, because remember, we would have gotten stopped out right when we were anticipating a bounce off of this significant horizontal level. We would have gotten stopped out right here. So no other trade orders would have been able to be placed because we would have gotten stopped out. That's why using a stop loss is good for a lot of traders, but that's why using a stop loss could be a disadvantage for a lot of new traders, just because it's sort of a death by 1,000 cuts scenario where you're losing a small amount of capital every time you lose a trade. Now, when you're hedging, you're more of just reacting to whatever the markets is showing you. So you don't have to lose a small amount or even a big amount of capital every single trade that you place. You could just react to whatever the market is doing. So you don't have to be right. And even when you're wrong, a lot of times you could still be right because you could just make a trading decision based on whatever's happening in the markets. So this is sort of how you effectively hedge in the foreign exchange market. So like I said, there are two different ways that you could trade the market. You could trade using a typical stop loss. So let's say that price is coming down to this significant horizontal level and you were just looking to trade a bounce off of this horizontal level. Then you would place your stop loss right below the level and then your take profit. If price goes and hits your take profit, cool, you made money. If price goes against you, you got stopped out for a small amount of capital. You're still managing risk because you're not risking your whole entire account balance, but it's not the most effective way to manage risk in my subjective opinion. Now, if you're using hedge orders, you could place a buy off of this significant horizontal level. And then if price does wipe through the zone, who cares? You still have a sell hedge right there. And then let's say we have a zone somewhere down here, because we're looking left and we're finding significant daily horizontal levels. Maybe price has reacted with this zone previously, and then now we're up to here, and this is sort of what it looks like. So let's say something like this plays out, where we see a zone down in here. We would have our sell hedge down here, and let's say price does end up breaking through and triggering our sell hedge, and then we could actually just have a buy order right here, so that when price does actually hit take profit here, and again, I apologize for being so informal with all of this, but this is sort of how I speak and how I trade. We would be able to capture a profit off of this move towards the downside, and then we could try and capture a bounce off of this significant horizontal level. If price does end up bouncing, even if it's halfway, we profited off of this sell hedge, and we could profit off of this buy, and then we could exit this buy into a tiny drawdown to the point where it's a break even for both of these trades, and then it's a profit off of this trade. So it ends up being a net profitable trade. And even if price does break through this significant horizontal level and it doesn't end up bouncing here, who cares? Because we could have another sell hedge right here. It's most likely that price isn't going to disrespect all of these significant horizontal levels. there's going to be a time where price does end up bouncing, and when it does bouncing, it will end up being profitable for you, or even break even, worst case scenario. So that's why, in my subjective opinion, hedging is better than stop losses. But it's important to understand and implement whichever risk management practice works best for you and your strategy, and just keep utilizing that risk management strategy. With typical stop loss risk management practices, you're risking anywhere from 1 to 3% of your account balance. But with hedging, you may want to risk a little bit less because you're placing more positions. So I usually risk around 0.5 to 1% of my account balance when I'm hedging. But when I'm using stop losses, I use 1 to 3% of my account balance, just because you want to be a little bit more aggressive, especially if you're using stop losses, because you're getting out of that position and you're not using any more of your account balance. With hedging, you could get some more exposure, especially if price goes away, like way away from your hedge entry. So like if you get hedged and then price just goes all the way towards the upside, even though you're not losing more of your capital, you want to make sure to a lot less of your account balance when you're hedging. So that is all I got for you guys. If you guys have any questions, concerns, comments, make sure to drop them in the comments below, and make sure to hit that subscribe button. I'll see you guys on the next one. Cheers.